Yeah, it's saying it's failing to update Twitter, but I think that might be a glitch because I think we're getting some comments. So, all right, we're live.
All right, Bob, here we are on a fantastic Friday.
Yeah.
I'm just going to shout out. This is David Morgan. I think most of you know that, but I do a weekly perspective every Friday, and I start off with the weekly perspective for the week ending 14 November 2025. But this is a special one because I'm live and in person with Bob Coleman. Bob and I have a history of almost 2 decades, I think.
Yep.
And we have slightly different views, let's say, than the majority of precious metals people. So, Bob, I'll just hit you with a hardball right off the bat. Is this manipulation or normal market activity?
Well, I think for the guys that are on margin, it may feel like manipulation. But when you start seeing the bludgeoning that we're seeing in crypto, and that's bleeding over, especially in the tech stocks. I mean, you're seeing some big companies with some big drops or drawdowns. That creates margin calls, and that creates forced selling in asset classes that starts to snowball into other asset classes, and so and unfortunately in the precious metals world, it's not just all physical owners. You know, we're kind of lumped in with a lot of leverage traders, algorithmic traders. I mean, it's options. So when these things start to move the opposite direction, you know, you have to unload. You don't have a choice. And then of course, if you have margin calls and other parts of the portfolio, you have to sell whatever you can. That's viable. And sometimes the precious metals are number one. So.
I don't think you can expand on that, but I mean, the number one question I get the most often is if there's a large sell off in the market, what will happen to precious metals? And the answer is obvious. They sell off as well. I don't know if you want to embellish that any further or not, but I think it's, what I would say is it isn't a banker consortium saying we're selling off the metals. It's the most liquid asset in many cases. So,
Yeah.
is there anything else?
Yeah, I think you're right. I mean, it's sort of a bedrock that I think a lot of institutions will rely on. Unfortunately, I see a lot of the manipulation crowd talk about banksters and smashes and all these types of things, which is somewhat counterproductive for the retail investor because they start believing that mantra. And on these rallies, what I've seen is them selling into this, thinking, okay, they're just going to smash it back down, and we're going to be kneecapped and the prices will never rise ever again. And so people have been selling all the way from 26 on up. Unfortunately, and they've held for a long time, and but I think if people just focus on the long term, which you and I both agree is that's why we're in this game. You can kind of wade through that day-to-day volatility, which a lot of times is more positioning by whether it's banks, market makers, big funds. Talking about the equity market makers getting involved on the short side of SLV and PSLV earlier this year, where silver was really tight and so forth. So there's different markets or different times of the market will have different types of behavioral characteristics. So you can't just lump one simple explanation for every move. You got to kind of study it, understand it, and kind of watch for the breadcrumbs.
Yeah, I think of the market actually in like two ways. I mean, there's so many ways, but basically you've got the commercial bars, commercial side run by derivatives, and then you've got the retail side. So as I've said many times before, you can have a tightness in the retail sector, which has nothing to do with the wholesale silver bar market. They might be finding places to stack more bars in the past.
Yes.
Now we're in kind of a different situation. But before we leave and go to the retail side, I'd like to look at the leverage side a little bit more. So you've been probably the best to my knowledge, and that's because we're friends. I try to be objective with everyone. I'm seeing things in like the short selling, the exchange for physical, and the inability to find paper too short in the SLV. And you made some remarkable calls that other people didn't see. Can you go through that a little bit for us?
Yeah, the tightness kind of starts to appear in different forms. Financing is the biggest issue with metals because what most people don't understand is, yes, as physical investors, we buy the physical and we store it, and we think that's the end of the story. But for the financial side of the industry that trades this and uses it as collateral, and they leverage and they lease and they loan against it and so forth. There's a lot of spreads and a lot of these sort of um, uh, dynamics that happen with pricing that you can kind of watch and understand when tightness starts to appear, because these spreads start to disengage from their normal activity and they start blowing out. And like the exchange for physical premium earlier this year, when it went to a massive contango, or the futures price accelerated higher or faster than the spot price did, and that caused anyone who was hedging a lot of pain, because their hedges were blowing up, or meaning they were going up, they were going against them faster than their underlying inventory was going up. And so that created margin calls to the upside, which squeezed the price higher. And then recently you had the idea of a massive contango, where all of a sudden, or I'm sorry, backwardation, where there was a big need for physical in London, and metal was just happened to be in the wrong place at the wrong time. It's sitting a lot of it in New York, because earlier this year, millions of ounces moved from London to New York. Now they had to move back from New York to London. So when the backwardation appeared and you went to a $2, $2.50 discount, where the futures were cheaper than the spot, it made more sense to sell it in New York, or sorry, buy it in New York and sell it in London, and capture that arbitrage. And so banks and traders will do that. And so, but it's a natural. That's how the pricing mechanism sort of balances it out over these volatile periods. So there's arbitrage that does come in, and people that do take opportunities to take advantage of that. Now those people tend to be very big players. The banks, I know we all kind of joke, there's very little times that the banks actually lose money, because they are the markets. I mean, that their job is to obviously get it right, because if they don't, they're working on borrowed capital. Their job is to make money on spreads, not necessarily on secular trends. So it's, and that's on the trading side. Maybe the prop desk and their money management side is different, but just trying to watch these flows, you get a better sense of what the market is really doing under the surface, rather than listening to this repeating mantra of manipulation, which doesn't really, it doesn't, naked shorting, all these types of things, these terminologies that sound sort of grand on paper, but don't mean anything, because there's nothing behind that to back it up in terms of actual statistics, I guess. It's a Friday morning. It's been a long week. But no, I think yeah, from a standpoint of the short side of the market, I think people just need to understand who the shorts really are. In most instances, the shorts are either people that are long inventory and just using it as a hedge, or you do have speculators that are coming. Like, for example, we just had like a little double top on silver. If you look at the daily chart, and there's this old mantra, you see a double top, you sell a double top. And so you had that come into the market. But I think more so, you had a lot of pressure across the board, like we've seen the last couple of days in the tech market, AI unwinding, crypto unwinding, Bitcoin unwinding, and that pressure, you may see players come into other markets sensing weakness, kind of like blood in the water and the sharks come. They'll try to press the market lower. Now, the real question is, with the metals markets, is these are great times that test the uptrend. And this is what you want to see, because this is what strength exemplifies, is holding on to those Fibonacci retracements or trend lines or moving averages. Those are there for reasons, and technical analysis is sort of the art of watching where everybody's watching the same chart. And if we hold these levels, that builds sentiment and that builds momentum, and that's how the market breathes and works. And it's not just this idea of manipulation and artificial suppression and selling and just complete negativity. And that's what I try to promote, is that more educational type of.
Well, you generated so many thoughts in my head. I got a double question for you. One, Do you think enough metal has moved from New York to London to clear the market? And the second question is back to arbitrage. What do you make of this arbitrage between the SGE and the other markets? Because it seems to be at least from what I've read, kind of a habitual discrepancy in price between the Hong Kong, Shanghai Gold Exchange and what you see in New York or London.
Yeah, the Chinese market I don't follow as closely as a lot of others. It's obviously it's a being in another continent with its own rules and so forth, it's a little bit more difficult to kind of catch the flavor of what's happening over there. But yeah, as you saw sort of this tax revenue or tax policy that they implemented, trying to drive a lot of the exchange, or sorry, a lot of the purchasing behavior onto the exchange, I think is more of a centralized type of thing that China's trying to capture tax revenue, make sure everyone pays their fair share. And then they also can control sort of the narrative rather than the public just trading with over-the-counter players that may not be very reputable, they may not be very well capitalized, and this also may help protect the public's interest as well. But yeah, you have this VAT issue with China, value-added tax, and I know there's an exemption when you're going through the trade-free zone over in Shanghai. You don't have to worry about that as much. But yeah, it also these arbitrage or pricing dislocations also are really impacted more on supply and demand of those specific regions more so than the general market. And I think that's what people may not understand is even though retail isn't buying a lot here in the U.S., um, you know, it doesn't mean the price can't go higher because we're just a subset of the entire globe. I mean, China and India are just phenomenal physical players, even though we buy a lot of physical as well. But so these it seems like one country drops the ball, another picks it up and runs with it, and you get this sort of constant rotation of activity, and that's where these pricing dislocations tend to be set off from location to location.
So I'm going to throw one at you and see, you can shoot as many holes in it as you want or agree, but we're at a place where we haven't been in, my career basically, and that's a print at 50 and another print at 50 and another print at 50. I mean, the high of 50 in January 21st, 1980 or thereabouts was momentary. And we really didn't hit 50 in the 2011 high on the spot side. And so now we've actually made prints where we're actually dealing in physical metal, both commercial and retail, at 50. I say that market is telling us, not me telling us, that we are at a new level and we probably could go higher. What do you think?
Well, your rule, and I remember it vividly, is if it holds above for 3 days, you got to start respecting it. And lo and behold, we've held above 50, a number of days. And yes, there's got to be volatility. And you look at these retracement levels, and this is healthy when it breaks and when it moves around because you're really just shaking the weak hands out of the market. Yeah, and I know a lot of people trade miners and mining stocks, and sometimes the mining stocks, they aren't the metals, and you can get this volatility in the general market where all of a sudden the metal starts to diverge from the mining stocks, and it's just because of general market activity. Those are strong events for the underlying physical because it shows that people still have a distrust for the system, and they see the reasoning and the value of the actual underlying metal. That's the tough part about trading mining companies rather than metals is sometimes there are different dynamics altogether. But no, you're right. I think the market's telling us that, and it's been telling us really since 2023 or so when I did the silver symposium, and I was sitting there telling people, I go, the market's going to start to move. Retail is not going to trust it. It's going to start working its way higher. Retail is going to sell into it all the way up. And that's exactly what's happened, unfortunately. And what's happened is the bigger players, the higher net worth individuals, ultra high net worth individuals, they have been the buyers here in the U.S. that have picked the ball up and ran with it. And so you just got to identify the changes and sort of the characteristics of the market. And I think you're right. Holding above 50 is telling us that there is a lot of interest up here.
Well, typically the next question, you already alluded to it, and that's about retail. One of them isn't retail for a while. So from what I know from you and others, because I check with other dealers, where the buy and sells, and really we've seen a lot of selling from retail, and I can be empathetic toward. Oh my goodness, I bought it 30, 33 back in 2011, and I'm back. It's 35. And they're out, or it gets in. They see 50. Oh, it's never getting above 50. It never has. It never will. I'm out. Well, you only give me 48. Well, the spot market's 50. Well, take it or leave it. And so we know that markets need new buyers from time to time. And I'd say, from my perspective, we need to see fresh buyers into the metals markets. Where's that going to come from in your opinion?
Yeah, it's mainly been more from, if you watch the capital flows over the summer, it really started to pick up in the institutional crowd, the sort of the money management crowd, the momentum players going into the derivatives markets. Options have become a really in overall, just not just metals, but the stock market in general. Options have become a enormous market, especially over the last couple of years. Robinhood, a lot of these broker dealers are promoting, easier strategies or more broader strategies and complex strategies, putting them into an online platform that traders can use to maybe use as leverage to maybe, play the markets where it used to be just professionals trading or very sophisticated option traders where they do these really crazy strategies and playing convexity and all this other kind of stuff. I think if you looked at the October timeframe and you started to see it actually unfold this week as well, where volatility starts picking up, and many people may not realize this, but unlike the stock market where volatility rises, the market traditionally goes down. Volatility in the metals markets work the opposite, and that's been the case since 2023 forward. And identifying that, there are times when the market goes down and volatility rises in the market in the physical metals markets. But what we've seen is this increase of volatility, increase in prices, and I think that's being driven by these gamma squeezes, where dealers who write calls to the public who buys them most of the time, as we talked about, last night. 80%, 90% of the time, these calls expire worthless. But they haven't been because there's been so much money going into these products and then the structured products. A lot of people may not realize it, but SLV is this is the iShares, BlackRock iShares Silver ETF, is a very popular product to use for indexing by institutions. It's very deep. It's a very, it's the biggest silver ETF out there. So they use that as a derivative of the real underlying physical silver, but they use it in a structured product in a vehicle where, for example, if an institution wants to come into the market, they want to play the silver price. They say, listen, it's very volatile. We want to limit our downside, we don't mind giving up any, a little bit of the upside to have that sort of insurance on the downside. They call that a buffered product. Well, you may give up, say, 10% of the upside, or you may only engage 90% of the upside for, maybe the first 20% of the downside, you're protected. And then, after that 20%, you have a one-to-one relationship on the downside. But options are a vehicle that the broker dealer and Wall Street world uses to, and that has become much more prevalent, not only in the metals, but in the general market. And that's this tail wagging the dog phenomena that we're seeing. You look at NVIDIA, going to almost a $5 trillion company, larger than Japan. This is financial engineering at its finest. Now, the downside to that, though, is, financial engineering, when it's human made, can also come unglued. And it's getting to a point where liquidity is so important to keep this, liquidity is literally the glue holding all this stuff together. And that's why there's so much attention on the Fed and so forth. And I think that's when you start looking at that bigger picture, that's what's bringing people into the metals, not the gold and silver bug crowd, the traditional hedge fund manager or the traditional large investor that says, hey, listen, I'm starting to understand this game here a little bit, and there's really no way out. And any crisis is going to have to be met with more spending, more deficit spending, and debt structure and all that kind of stuff. At the same time, they have to figure out how to maintain and all this debt, not only the issuance but also the maintenance of all this debt, paying the interest and that type of thing. And the only way they do that is to try and manage interest rates lower. Well, metals make a good case for that. And I think that's where central banks have stepped in the last few years. I mean, not only the last few years, but the last 10 years. But I think investors have picked up on this notion. And you're right. Those are the new buyers that have come in and sort of taken the reins. And the traditional retail investor that follows a lot of these promoters and a lot of these retail dealers have really missed the mark, because the promotion to get people to buy metal tends to be very negative, fear mongering, trying to build up anxiety, get people sort of off the couch to pick up the phone and buy at a high premium without thinking. And, of course, then they throw in the high price targets of $500 silver or $5,000 silver and $25,000 gold. But those are just most of the people that I think the higher net worth individuals don't look at that type of marketing. They look at it more on a valuation type of model, and they realize there is more to the story than just simply the end of the dollar. The debts are going to blow up, and the stock market's going to crash, and the only thing around is going to be gold and silver. That type of mentality. I always joke with clients. I go, if we ever had that kind of meltdown in the markets, you would see gold dealers go out of business before you'd see banks go out of business, because a lot of gold dealers work on lines of credit.
Absolutely.
And I think that's what the public has to understand, sort of the dynamics of how this industry works.
But let me interrupt you for a second. You've almost answered my question, so I'm going to give you a hypothetical. You are a registered investment advisor. You run a hedge fund, and so I call you up. Hey, Bob, you recommended or saw you on X or whatever, and I am 60 years old. I have $2.5 million liquid. Half of that's in a self-directed IRA, and I own no metal. But I'm a little worried because gold's at an all-time high and silver's at 50. What do I do? What would you say to someone like
Yeah, talk about putting me on the spot there.
that? Well, you can't say I refuse to answer.
Yeah. You should have bought it 2 years ago. No, I think having, for someone like that walking into the markets, dollar cost averaging is one way to do this, where you're using volatility as your friend. Now, the last 2 years, it hasn't worked as your friend, because you end up just paying more and more and more. But the idea of saying, listen, if you've never bought metals before and you're just trying to get exposure, start small and get your feet wet and try to understand. Because a lot of times, once you make that first transaction, I know you've told me this when I first started talking to you back in 2005 and 7, and you get the bug. And you get that sort of, okay, now I feel more comfortable, but it's not like this thing's going to go to zero. I have no one to sell it to, and it's like going to just become dust and, attract dust in the corner of my closet. It's a very liquid investment. So once people start to get more comfortable with it, I think then there's not that stress and anxiety of, well, my God, this price is just moving around like it's a yo-yo. I mean, especially silver. Silver is one that, if you're not used to it, even physical players that buy it and don't even watch the price all the time, 20% move is nothing in this market. But if you're trading this thing or watching like on an ETF basis, and you see the price every day, and you're watching mining stocks, and the volatility can definitely scare you out. And so I think for a lot of this, like that individual, that type of scenario, start small, build into that position. If you have conviction, maybe put a little bit more into it, thinking that, okay, this isn't something that even if the market drops 20%, I'm going to panic and sell out. This is just a portion of my portfolio. And I think that's the best way to look at it.
Good. Well, circling back to how leveraged the whole system is. I mean, it's you can't almost calculate how much leverage there is when there's, options on futures. I mean, I won't go into it, but do you think that's a concern? I mean, Buffett certainly thinks it is. Do you think that's what would you say are one, two, or three, one at least, major concerns for not only leverage, but the system as a whole? Because one is confidence. So that's a psychological factor. I don't trust where the dollar is going to be worth 6 months from now. Um, the ability to lever up in the stock market with the average investor getting to about 50%. I got a $500,000 portfolio and I can borrow 250,000 and I'm going to do it. The stock market only goes up. Where do you see this? I don't want to say landing, but where do you see the biggest risks?
Yeah, I think um, the debt deflationary scenario is obviously real. And we get into these liquidity cycles of, the Fed prints a lot of money, or actually, in reality, what's been happening the last couple of years is this has been a very engineered rally in monetary policy from actually the fiscal side, the government side, not necessarily the Fed side. So we're in we're for most investors they're seeing history right now, because traditionally the US Treasury Department does not do monetary policy. They focus more on fiscal policy, the spending of government and so forth, and using the government's fiscal spending to provide stimulus into the economy. But what they've been doing with changing the duration of treasury instruments to a much shorter dated policy, what Janet Yellen did, basically taking 70 or 80% of the U.S. Treasury issuance and going into 1 year or less paper. Now you're forced to turn over this paper much quicker. Yet there's advantages to it and disadvantages. The advantage is you can get a lot of demand because that paper is somewhat risk-free because it matures so quickly. You don't have that duration risk and interest rate risk where interest rates start to go up and the longer dated paper starts to go down in price. It's easier it's much more even keeled. And then also banks are willing to lend against that paper as well. So what's happened is you've had this dynamic where part of this leveraging or financial engineering has come from hedge funds, offshore funds, offshore banking centers. Cayman Islands has had enormous growth in the participation in the U.S. Treasury market. You've had what they call a basis point trade, where hedge funds will buy the new issuance of U.S. Treasury, say the 10-year Treasury. They'll buy the Treasury and then they'll short the 10-year futures Treasury, and they'll make a spread. Very similar to the metals markets, where you buy the spot market, you sell the futures market, and you make a few cents per ounce, but you do that on a leveraged basis. It starts to make a lot of money. And so that's what's been funding the U.S. government really since the last couple of years. But and it's picked up obviously this last year as well, because the Fed hasn't really enjoying by printing money, expanding the balance sheet. They've been, it's been running off because of the reverse repo facility going down near zero. And so it's been private uh, um, funds with leverage that have supported the U.S. Treasury market more so than anything else. And you see it with primary dealers not being as active at holding large positions as they have in the past. Banks haven't been, they've been lending against treasuries, but yeah, the support through the repo markets, but the big support has been just private funds and private capital and leverage from those private capitals. That's been the increase in money supply and the increase in buying power. It hasn't really come from the Fed, and that gets scary because all of a sudden, when that starts to reverse, those players don't have the pockets like the Federal Reserve does. They don't have the ability to print at will and expand balance sheets at will and do swap lines of credit, all that other stuff. So those players will be forced in any type of unwinding or dislocation in the markets to start unwinding those trades, and those trades will overwhelm the system, and that would create that downside move that that you're alluding to that could come out at any time. And that's what the Fed and the U.S. government and obviously a lot of banks and everybody's watching. They're trying to do their best to manage the markets. That won't happen, because if it does, they can't stop it.
Well, early on when I started on the speaking circuit, I used to show a short clip out of the movie Rollover. And we're in that kind of situation with the repo market. I mean, isn't like almost $1 trillion in overnight lending just to keep the bank solvent because they have to have a certain requirement every night at the end of the day to meet the requirement from the Federal Reserve. Well, when you got that much at risk, and as you said, they can't print their own money, they don't have a swap line, they can't just go in the backyard and pick it off a tree. And that's what my biggest concern has been probably all the way up since I started studying markets, not just the metals markets. I mean, I think to be good at the metals markets, you got to be good at macroeconomics because everything feeds into gold. And I'm not trying to puff up you or me. It's just a fact. If you don't look at the big picture, and that, of course, is the debt markets. And this is one I can't answer, but it's the Friday, so it's the bonus question. Where do you see this problem with not being able to ever pay off the debt and maybe not even be able to service the debt at some point? I mean, I know what's happened in history. I'm a student of monetary history, but I just can't fathom it happens to us, the U.S., but yet it's almost inevitable.
Yes.
How do you see it?
The perfect answer for this is the relief valve ultimately becomes the currency, and in our case, the dollar, and the inflation of that currency is the pressure relief valve. Imagine a pressure cooker, and you get the little valve on top of the pressure cooker, relieves that steam. That's what currency does when it starts to inflate away out. There's no other way to pay the stuff off except with cheaper and cheaper money. That's what every fiat currency unfortunately has done since the beginning of time. And the funny thing with gold is that it has stood through every civilization, empire, financial engineering event, markets. It stood through that because it ultimately was an anchor that you can't print it, you can't replicate it, and it's finite, and humans have developed this attraction and sort of they see value in it, and it's behavioral. And I think that's the simple back of the business card type of answer.
I agree. I don't like to see it because, from a moral aspect, it's actually better to do a debt liquidation and say, okay, interest rates are 12% and the bond market goes accordingly. I think anyone that knows finance knows that when interest rates go up, bond market values go down. So now I'm illiquid and my $1,000 face value bond now fetches me $600, but I need the cash, and that's deflationary. It can actually balance itself out, at least in theory. But I don't think we're going that way. I agree with you.
Yeah,
and that scares. Go ahead.
Yeah. You. If we really went down the deflationary wave, and I've seen this before. I mean, being in the business since 1992, I've seen 94's markets where you had the worst bond market in history at the time. You had Orange County, California, go bankrupt because they were playing inverse floaters, expecting interest rates to go down, and the Fed just starts raising rates, and that presses anybody who's leveraged on the wrong side of the market. You had 98 long-term capital, you had the Asian contagion, you had 2000 bubble with the internet, the 2008 crisis, obviously GFC. You get these periods of deflation and unwinding, but it comes from all this monetary creation. And it's this unfortunate cycle that we live in, a boom and bust type of thing that I think as metal owners, we're trying to say, hey, listen, we're just trying to protect our capital. At the end of the day, I buy this stuff because it's long term. It's the only way out of this mess is to come to the markets with more money, and try to financial engineer itself. Because in reality, if the music stopped, I don't know, it wouldn't be a happy place. And I think most people, they look at $10,000 gold or $25,000 gold, and these dealers promote this idea of $100,000 gold. I don't know if you want to live in a world with $100,000 gold because there will be nothing on the shelves. And that's a scary proposition. So, they're trying to maintain a system that needs inflation because that's the only way we can grow in this country. Unfortunately, as a population increases or as You have baby, you have the retirement community, pension funds. You need to have some form of inflation, um, to especially to maintain the credit cycle. But I think the concern is, any type of reversal in the markets, and it's scary because it can come. Is you're going to have so many more players that you're not expecting to maybe be in the crosshairs, but ultimately will get caught up in that volatility that you're not expecting. I mean, you look at Tether, for example, no financial audits. They're one of the largest holders of U.S. Treasuries, and yet they're allowed and they're exemplified in the marketplace as a bank. I mean, they get that same notoriety, but they've never had a financial audit done.
Yeah.
I mean, that's scary because you're not. I mean, the one thing about regulation, I think the positive side is you're trying to keep some degree of rules on the system without it becoming unhinged. It's like going to the bowling alley and you put the guards up along the what do they call that, or the rails. To try and keep the ball on the lane. Well, that's what regulation kind of does, and it tries to weed out the bad players. Well, with this, I think what we're seeing, unfortunately, in the markets today is a lot of deregulation and a lot of sort of allowance of a lot of these instruments that are untested, and they're there to promote, I think, asset appreciation and the wealth effect more so than they're there to protect the integrity of the system itself.
Great. Have we had any questions come in yet?
No, not yet.
Okay. Well, I'm pretty much there, Bob. Is there anything that I haven't asked you? Anything you'd like to wrap up with on this glorious 14th of November,
Oh, got it.
2025?
I was gonna say we started out the week. I know we did Tom's podcast with gold up $100 an ounce that day, and now we're doing it with gold down $100. Boy, what a roller coaster ride this week. And I think the move today is more impacted by the general market activity. I think more so than the characteristics just in the physical metals markets. I know people watch the silver market and they see this double top on the daily charts, and you get people that are saying, "Oh, look, they're going to sell this double top and try to drive silver back under 50 and that type of thing." I think this move is more so just a function of just the liquidation that we're seeing, and obviously the markets are still young this morning. One of the things that we were talking about before we went on is this Thursday, Friday, Monday event where Thursday you close at the lows, and this is more traditionally for the general market, but it's sort of a rule that I kind of follow. You close at the lows on a Thursday. Friday morning, it opens up down. You have a big rally in the morning. That rally fades. You close at the lows on Friday afternoon. And Monday, the margin calls really come in. And I think that's what I think a lot of people are kind of watching for right now is, they're seeing sort of the bounce in the markets. You want to see how the afternoon kind of unfolds, if the strength kind of stays there, or if this is short covering, after this big drop that we had this morning.
Very good. Well, I think I'm about where we're ready to close out. And I want to thank you for your time and friendship and knowledge base and everything else.
Oh, I appreciate you stopping by, and it's always good to see you. And you got a chance to kind of see our facility and all the good gear that we use.
Definitely.
Yeah,
Thank you, Bob.
sure.
Excellent, guys. Well, have a good day. See ya.